Alright, let's go over the Gauntlet gap. I don't know, that's what ICT calls it. We can call it something else. I think it sounds pretty stupid, honestly. Let's see if I can find one here. Just on overnight session. Let's see. Alright, let's look what we have here. So basically, what the Gauntlet is when you have, let me just draw it out like this first. Let's just say prices coming down, making lower highs and lower lows. So what the Gauntlet is this. You have a high and a low, and it comes up to make a new high, but that new high has to be formed within a fair value gap. Okay? And then we make a new low. We don't have to make that low, but just for now, let's just say we're going to make that low. So it becomes essentially a breaker. So basically the Gauntlet is when this high makes the new low, and then we break through that high with a BPR. So we have a SIBI here, and then we want to have a BPR on the right side of the curve. It doesn't have to overlap, but it has to be somewhere on that leg that breaks this high. So let's just say we have the BPR here. Let's just say we make the BPR there. Okay. So this becomes a Gauntlet gap, a Gauntlet fair value gap, or whatever you want to call it. Okay. And essentially this BPR here that breaks through this high needs to function as support. Okay. So we can have our typical, CISD and all that down here with an inversion fair value gap, all the things that we look for typically. The breaker would even be here as well. And you have your turtle soup. Okay. So the same stuff that I always look for. But what this does is give you extra confirmation, and it kind of makes you wait until, like, instead of just going in right here on the CISD, it kind of makes you wait until price gets above and starts to really create that right side of the curve, and then we come back and test it, and that's when you can get in. Also, with balanced price ranges, it really plays well into that, and I'll show you what I mean. But essentially, this is the Gauntlet gap, and this is where you want to enter, or you can enter on the close above or whatever. There's multiple ways to enter that. But essentially, you want to have this as the SIBI, this as the BPR, and it's reversed for shorts. This could be higher, this could be lower. It just needs to be in the leg that breaks this high. So, like, basically you want to see down close candles, and then you want to see consecutive up close candles through here with a BPR somewhere along the line that breaks this high. Typically a 3 candle pattern, so you have to have a 3 candle pattern anyway to make the BPR, so you want to see 1, 2, 3 bullish candles somewhere that breaks that high. And then this functions as support, but also this as well. Okay, so you'll maybe tap into that gap. Maybe you don't want to go long right there. Maybe you want to wait until we close back above the Gauntlet. the high of the gauntlet again. So you can enter here, okay? You can enter there, or we can enter here, 50% of this gap. Stop below the third candle wick low or the swing low. Same thing here, stop below the low, you know, or you can take it all the way down depending on how much you want to risk. But that's essentially it. So let's just see if we can find I mean, this is a live model here, so we have the cycle open. Okay. The cycle open. And I'm just going to use these like I do the 4-hour opens. Okay, so open, go lower, we take this liquidity of the previous cycle, and then we have the reversal. So we have a tiny gap. It really doesn't matter how small it is, because it's probably a little larger somewhere there on the 15-second, but turtle soup. So typically this would be it right here. So either this candle's close or this candle's open. CISD. Gauntlet. There's an inversion in here as well. The only thing with this one, it doesn't really retest, but it's you know, London session overnight. They're not, sometimes it just, you don't get the best price action. So in this case, like, you would just miss the trade or enter here. Let's see if there's a 15-second entry. Sort of get one here. Okay. That's the gauntlet. You get a retest of it on this 15-second chart. Okay. So all this here is the fair value gap, becomes the gauntlet. We come up, test it, make a low, close up above it. Okay. And this is what I'm talking about. You have 1, 2, 3 candles. Those 3 candles form a fair value gap. So in the fair value gaps, the way ICT teaches it is that you include the volume imbalances with it. Okay, so this is a bit ugly, but you include that whole range there. So like here, from this to this, in this example, instead of going here to here, like, you would go here to here, okay? Because you have the volume imbalance. Right there. That's a volume imbalance, okay? And so your entry would be, you close above, enter on the retest, stop goes here. So normal stop would be here, 1 tick below that low. More aggressive would be below the 3rd candle, and extremely aggressive would be either the low, 1 tick below the low of that gap, or 1 tick below the volume imbalance. And then, you know, you just target whatever buy model, you know what I mean? Like, this could be it right here. Target those equal highs. It's like a 1 to 2, or you target the previous cycle high, previous 30-minute cycle high, whatever you want. Let's see if we can find another example. Okay. So here's another example on the 15. We have this gap, okay, we have the downtrend, price comes up, retests that, makes a low. Just pretend we take liquidity. We don't take liquidity here, but just pretend we do. This becomes what we consider potentially being the gauntlet. So you're once you see that low get created, you're anticipating this to function as the gauntlet gap. But price just consolidates, so you just drag that out in time, and then basically, because that's your range anyway, that high to that low is the range. Nothing gets above, gets below, you close above here. Okay, 1, 2, 3 candles. This becomes your fair value gap. Okay, so this becomes the gauntlet. This becomes the gauntlet fair value gap whenever this forms. Okay, that 1, 2, 3 pattern forms. Now this becomes the gauntlet. Not until then. Before it's just an inversion. Before it's just that. Okay, or it's just this. But once these 3 candles form to break that high, that makes it a gauntlet. And then basically you drag that out in time, you drag this out in time, and that becomes your support level. And you can see price respects it, respects this fair value gap. It just takes forever on this trade, but essentially, you know, your entry would be 50% here. Okay. And you finally get it here, right to the tick. And stop would be below here. Or you could enter right at the top of this fair value gap. Sometimes it doesn't actually get down to the 50%. That's why you include that. And then if you look, you know, it taps 50% exactly. It's just, I don't know. It's pretty nice to see that. And target above. Anyway, that's pretty much it. Let's see if we can find an example. Sometimes it is hard to find the examples in the 1 minute, just because sometimes the price doesn't come back to it. But let's see if we can find another example. I don't really see anything. Yeah, I don't really see anything there. Let's just go back a few days and see. Let's see. Here's a good example here. So cycle opens down here. It's also 2 a.m. open there. Cycle open. Okay, we run higher. Making highs, taking liquidity, and then right around here, right around here we get a gauntlet. So it's a little ugly, but it's very ugly. Tiny little gap there. Tap into it, run higher, close down below it. So that's your gauntlet. This becomes the 3 candle pattern that breaks it. So then you're going to go here, up to here, extend it out, and you really want to see that hold, that gap right there. Okay, because that gap formed the gauntlet. Okay, so then price gets back into it. You can confidently short. You can confidently short here with your stop here, here, or here. Okay, I would probably do here on the 3 candle pattern. And then targeting cycle open, but really you want to target the cycle low to complete the sell model. See what this looks like. Okay, we have one here, 15 seconds, so this becomes the gauntlet. Okay. So this could be the gauntlet as well, depending on how you're viewing it. But basically we make a high, make a low, run higher, then break through that, or we can say we make a high, make a low, tap into the gap, make the last run higher, and then this doesn't make a new high, we roll over, close below. Okay, 1, 2, 3, this becomes your gap. Price retraces back up into it. You can go short as soon as you get into that fair value gap, stop here or here, targeting the lows. If you want to use this gap, it doesn't come back to it. So 1, 2, 3. Then your risk reward is just off a little bit. But you want to try and use the higher gap, obviously. It helps with the reward, risk reward. I mean, it happens everywhere, honestly, if you just look for it. But I think this is the missing piece, honestly, that I've been ignoring. We already learned this. I already learned this with Zusi, but I think piecing it together with the way I look at the market now really makes sense. Just keeps you from, it kind of lets the right side of the curve develop a little more before getting into the trade. And then also using the cycle opens. Like, there's a lot more opportunity for the trade when you're using the cycle open rather than just the 4-hour open. Because you can essentially find a trade every 90 minutes, as long as you have some liquidity being taken. So you really want to wait on this new cycle, and then you want that cycle, the first 30 minutes of that cycle, to take out the previous 30-minute cycle. If it doesn't, you wait till this cycle, this 30-minute cycle. Once that 30-minute cycle takes out this 30-minute cycle's liquidity, high or low, then you can look to trade. If it doesn't, then you wait on this cycle to take out this cycle's liquidity. And then if nothing happens, you wait for the next hour and a half cycle, 90-minute cycle to open. And what do you want to see? You want to see this cycle take that cycle's liquidity, which it happens here and reverses. If it doesn't, you wait for this cycle to take that cycle, and so on and so forth. See here, we just open and trend because we've reversed with this cycle. This whole 90-minute cycle reversed. So now for current price, we have the cycle open here, which is also above 6 a.m. open. Okay. But, you know, we are in what looks like to be a buy model as of now. But you have this cycle open. We've taken this liquidity. Okay, taken that liquidity there. And now this is forming a gauntlet. Just wanted to see if this was an hourly fair value gap, and it is. So we open the cycle, run higher. It's also 7 a.m. So this is a potential gauntlet here. Okay. You just have to anticipate it before it even happens. So you see that, you see that, you see that, and now you think this could be a gauntlet if we get that pattern of closure below. If it's clear on the 1 minute, there's really no reason to go into the 15-second unless like you get a candle closure here. You get a candle closure here and you don't get a gap on the 1 minute, but you're confident that that's a short, then you can zoom in to see if within that candle closure there's a 15-second gap that you can take advantage of, just for risk purposes, you know what I mean? So like if that 1 minute candle ends up looking like this, you can use like these 3 15-second candles as your entry. Whenever that's just one 1 minute candle and there's no fair value gap, you can see if there's a fair value gap in the 15-second, and then you utilize those to keep your risk tight. But it needs to close below. Okay, you need to have a closure below that gap. So yeah, and then we can just tie it into these as well. Okay, I don't really use that, but H4 opening, tied in with that. Still use your SMT, 30-minute, 90-minute sweeps. You can still go within the macro windows, 50 to 100 levels, still valid. Order of reversal. So this is just stuff that, like, if you're going to use the gauntlet, you can use this as like a precursor. So like you want to see the turtle soup still, okay? You want to see the, sorry. I don't know what that is. Okay, you want to see the turtle soup. You want to see the IFVG. You want to see the CISD. And then basically what would come after this is the gauntlet. Okay, because then you have a fair value gap, which usually forms the gauntlet, or confirms the gauntlet, and then a breaker along with that. So basically you would have as D the gauntlet. And if you want to stack the orders, you know, you can, like, this is your CISD right here. So you throw on the first order there if you want. And then you get the closure here, so you confirm the gauntlet, and now add to the position when it retests. When it retests there, you can add another position. So it would be, yeah, I mean, in this particular case, you probably just want to hit it right when it retests. Because the gap is up here. So the fair value gap is up here, so it's a little high, but you can wait on that. You can wait on that there, or you can just place the order down there. But with this particular case, you want to look for a balanced price range as well. And what I mean by that is, so we have this run higher that we buy, and then it balances it here. We run higher, and it balances it here. We run higher, we shift market structure, now we need to balance. Okay, so that would be balanced at this point. So once the price action comes up and balances these here, the volume imbalance, right now, so this section is balanced, so this leg of price is balanced, because we can treat that as a fair value gap essentially. Okay, so we tap into it, and once that happens, in your head you're like, okay, we shouldn't get above this, like we shouldn't close above that. So basically you can frame your trade off this. Okay, so from here to here, try and find a trade in between there. Okay, because that's all balanced. Once we come up and balance it, we hit the gauntlet there. Price is balanced. So actually, like, what I would really do here is look for a closure here and stop above here. So if we would close below that, now we made a new high, so I'm going to wait for a closure below this. My stop's going to be above the balanced price range. Okay, that's not showing up on the, let me, all intervals, let me go to current interval and below. So the stop would be above this high or that high, because if we run above there, potentially this is not a reversal. So this is actually a pretty good trade, you know, considering it's 7:30 in the morning. And then, like, the way I like to do this on the 15-second, if I'm not just going to put an order in, I'm going to wait for confirmation. I'll just sit here and wait. So if we have higher highs, higher highs, higher highs. I'll just keep looking at the, like basically the breaker, you know? Like that's a breaker there. So we close below, so I would be in. I'd be short right now. But I'm not gonna put a stop there, okay, because that could easily get wicked out. I'm gonna put the stop above the balanced price range on the higher time frame and just let it play out. But what I like to wait for is this. So you have the high, the low, the high. You have a closure below here. So that tells me we're starting to shift momentum there. And then at any point it could just drop off, or we could continue to make a new high. And I'll maybe stack into the position, just depending on the risk. And then in this particular case, this is all low resistance liquidity. So your first target here, previous 30-minute cycle, I wouldn't target these individually because they're all just low resistance. I would target this, obviously cycle open, 6 a.m. open are important, and then ultimately this would be the completion of the model. Okay, so right there, that's what you're looking for. All right, hopefully this helps you guys.